Hello and welcome to Earnings Echo. We put together the most important information about Amazon. Today, we're doing a deep dive into their Q1 2026 earnings report. We really want to answer one massive question for you. Is this aggressive push into AI a guaranteed gold mine, or is it a massive depreciation trap just waiting to spring?
Right, and to figure that out, we've got to look straight at the top-line facts. Q1 net sales hit $181.5 billion, so that's up 17% year over year, and EPS came in at $2.78.
But wait, you have to strip out that $16.8 billion pre-tax gain from their Anthropic investment to see the actual operating picture.
Exactly, you absolutely have to adjust for that. As for Q2 guidance, they're projecting between $194 and $199 billion in revenue, with operating income landing somewhere between $20 and $24 billion.
Which completely explains the tug of war we are seeing in after-hours trading right now. I mean, investors are just torn between extreme optimism over AWS accelerating and immediate panic over these skyrocketing capital expenditures.
Yeah, it's totally polarized.
So let's dig into the operational side, because I'm looking at this record 13.1% operating margin, and I have to admit I'm pretty stumped. How exactly are they achieving that kind of leverage when they're spending so heavily on AI infrastructure?
Well, it comes down to two very different operational realities firing at the exact same time. On the cloud side, AWS growth accelerated to 28% year over year. They just hit a $150 billion annualized run rate.
And the retail side, because I saw North America operating income reached $8.3 billion.
Right, the retail leverage is the real shocker here. International also finally posted a $1.4 billion profit.
Okay, so this margin expansion isn't just an AWS story. It's being driven by severe fulfillment efficiency on the retail side. They pushed 15% unit growth while fulfillment expenses only went up by 9%.
Precisely. You combine that kind of retail efficiency with a mix shift toward high-margin AWS AI services, and you get that 13.1% record. Plus, management's tone on the call was incredibly bullish on generative AI.
I mean, they already have over $225 billion in revenue commitments just for their custom Trainium silicon alone.
It's massive.
But look, it's easy to get swept up in all that AI optimism. When I look at the sheer cost of building the infrastructure, like the $43.2 billion they just dropped in cash CapEx in Q1 alone, I really start to worry about the macroeconomic risks.
It is a massive cash outflow for sure.
So to understand what this means for the stock, we need to run a reverse DCF, or discounted cash flow. For you listening, this isn't an exact science, but it acts like a decoder ring. It shows us exactly what future growth is already priced into the current stock value.
And right now, Amazon is the most expensive mega cap. They're sitting at a 2.4% net income yield. The reverse DCF shows the market is pricing in a 16% implied net income CAGR.
Meaning, to justify its current price, investors expect Amazon's net profits to consistently grow by 16% every single year for a decade, literally quadrupling from $70 billion to $307 billion.
Which is aggressive. Historically, Amazon has hit higher growth rates, but always from a much lower base. Quadrupling a $70 billion profit is a totally different beast.
Yeah, and this connects directly back to that CapEx surge.
It does. A $200 billion annual CapEx run rate creates roughly $40 billion per year in brand new depreciation. You see, data center buildings might last 30 years, but the actual AI chips and servers inside them, those only last 5 to 6 years before they're obsolete and need replacing.
It's like buying a fleet of brand new luxury cars for a rental business. You know, you can charge a premium per rental, but those cars lose their value so fast that you have to make a fortune just to cover the depreciation on the balance sheet.
That's a great way to put it. So this to actually be value accretive, AWS AI revenue has to generate more than $40 billion in new operating income annually, just to break even on that depreciation headwind.
And if they miss that, the depreciation permanently crushes their operating income. So based on all of this, if you're looking at your portfolio right now, what is the single most important echo you need to take away regarding the long-term investment story?
The main takeaway is that Amazon's recent margin expansion was an efficiency supercycle. It was driven by layoffs, regional fulfillment optimization, and that AWS mix shift. That cycle cannot be repeated. Moving forward, future stock performance hinges entirely on whether new AI revenue can outpace this massive incoming depreciation wave.
Which really leaves you wondering if the sheer computing scale required for agentic AI systems that actively complete complex tasks on their own will force the market to permanently revalue tech infrastructure. We might start treating these companies more like heavy utilities with massive capital intensity rather than traditional high-margin software growth stories. And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.